Welcome to Moneyman Investments. This is Long Story Short, where we cut through long stories, complicated data, and confusing narratives to present a very short, actionable brief on a sector or asset class. Today we are going to discuss the result season that has gone by for Q3 and how corporate India has fared. What we've done is condensed everything into one single data infographic. According to me, this is what matters the most. Now let me quickly explain this to you and how to read this. We have color coded based on the market capitalization. So Nifty 50, Nifty Next 50, MidCaps and SmallCaps. And then we have segregated them based on intervals of PAT growth in the last quarter on an year-on-year basis. So if one way to read this particular segment, the percentage of companies in Nifty 50 that showed a PAT growth of 10 to 20% are 15% a number. So all of these would add up to 100, all the color-coded ones, and then they are split into various growth intervals. All of this is only for PAT growth and on a year-on-year basis. Now there's something very interesting that has happened. We feel that we have actually reached the transition quarter that is leading us to a much better result seasons going forward. And this one particular quarter has shown that particular uptick. Markets may not have reacted yet, but it is important to see why this result season is extremely important. I've given some points here, but I'm going to talk in brief. And my objective is that by the end of this, in a few minutes, you will understand exactly how the entire result season has been. All of this data has been taken from NSE. So first is revenue growth hits a 11-quarter high. See, both the Nifty 50 and the broader market, that is Nifty 500, they both delivered a strong top line expansion in Q3 FY26. Revenues grew at 12.5% for Nifty 50 and 11.1% for the broader market, which is Nifty 500. A lot of festive demand, a lot of robust credit offtake has been seen. And it's very important to see that this growth is in double digits, mind you. We saw a sharp profits rebound in Nifty 50, and from a sluggish previous quarter, we've seen that there has been a good rebound that has happened. Large caps are steady but slow. Now what does that mean? The heavyweights are playing it safe, and they are probably meant for playing it safe investment wise. A huge chunk of the heavyweights, that is the large caps, have declared very modest growth, but mind you, on a big earnings base. You can see it here. The large caps are split between Nifty 50 and Nifty Next 50. And if you see, they are more or less averaging around these two. The negative or 0% and the 0 to 10%. This is where a big chunk of them are. Now it is but expected because these already have a huge base. But there is also margin pressure on large caps. So despite strong revenues, Nifty 50 operating margins have faced pressure and they've actually come down lower. There is a big shift in earnings concentration. The Nifty 50's share of total profits in the Nifty 500, that is in the broader market, so that is this dark green one, that has dropped from about 54% in last financial year to roughly about 51%. And there is a clear indication that earnings participation is broadening out to the smaller companies. So the earnings concentration is not only restricted to the bigger companies, the large cap companies. Remember that. It's a very, very important point. The broader market is showing great growth. Look at this. Mid cap and small cap. These two colors. This is where it seems the action is. The companies that have declared greater than 50% year-on-year PAT growth. This is where the real action is. And that's a significant number. Almost 1/4 of both of these two companies they fall in this particular segment. So if you're looking at a massive earnings beat, you will need to look beyond the heavyweights. There are no other options. This is where some great results have been reported. Now, this is also reflected from another metric, which is the declining contribution of Nifty 50 companies to Nifty 500 companies on earnings, which I just said. So companies beyond the top 50, they've delivered a massive 24.5% year-on-year PAT growth. That is far, far outpacing what the large caps have given. That's a big deal. There is a clear consensus upgrade for FY 2027. So for the immediate FY 2026 estimates were trimmed slightly. We are seeing a lot of analysts projecting a stronger growth for FY 2027. That means that we are expecting companies to grow much more in the coming financial year also. By now you would have gathered that MidCaps are rocking. Look at this. Almost 1/4 of MidCaps have declared a result PAT growth of more than 50%. If you look at the first two categories, that's about 34% of MidCaps. So while there are a few MidCaps here also, the biggest chunk of MidCaps, 1/4, fall in this particular category. Clearly they are rocking, and we've seen that recently in the market also, MidCaps have been showing a lot of strength. Small caps are both a risk and an opportunity. Why do I call it a risk? First, look at the number of companies that have reported negative or zero returns. That's a whopping almost 1/3, not 1/3, okay, about 28%. And on the other side, the opportunity is that almost 1/4 of these companies, small caps, have reported an earnings beat of more than 50%. They've shown a year-on-year PAT growth of more than 50%. That number is 1/4 of all small caps. So this is where the opportunity is. This is where the risk is. This means that amongst small caps, stock picking was never more important than it is now. And that is why I call it both a risk and an opportunity. So, bringing it all together, long story short, this is an out and out stock pickers market. It is not a market where everything will go up. And by the way, even technically, not everything is set up well to go up. Even from an earnings perspective, we are seeing the same. There is an incredible opportunity for alpha to be generated in the mid-cap and small cap space. And these look to lead the next leg of markets when they start going up. You would have already seen my video on how small caps are set up well. So it looks like we are heading towards that particular thing. What we are also seeing is that large caps at best are a defensive bet right now based on the earnings purely. I know that a lot of fund managers have been telling retailers to load on large caps, whatever the reason. What I feel is if someone were to load them right now, they would be taking defensive bets. But once the market starts breaking out of this particular bearish trend, we will see small caps and mid caps, select small caps, but a lot of mid caps start zooming from here onwards. So this is what we are expecting. Earnings have come up very, very well. Small caps are presenting a risk as well as an opportunity. It's important to stock pick, cherry pick very, very carefully. Mid caps, while they are looking good, not all of them will ever look good. Always remember that there will always be pockets of these companies that will lead the next rally. So one has to be extremely careful. This new bull run, it is very, very clear, will not be a general bull run where everything goes up. There will be a lot of companies that will just refuse to budge, while there will be few companies which will shoot up a lot. So it is extremely important to be in those companies. Well, that's about it for now. I hope this has been of value to you and your time well spent while watching this. We post a lot of stuff on our free markets channel, markets and economy channel. This is the QR code for the same. If you're part of it, you know the value that is being added over there. If you're not part of it, come and try it out for a week and see if you like it or not. Anyways, have a great time. See you soon.